Hi everyone. In this video, we'll be discussing the most common errors people make when building an investment portfolio and how to avoid them. Investing in the stock market can be a great way to grow your wealth, but making mistakes can lead to significant losses. Let's dive in. Error number 1. Not having a diversified portfolio. Diversification is a crucial aspect of investing as it helps to reduce risk by spreading your money across different types of investments. However, one common mistake people make is investing heavily in their employer's stock or a single industry. This creates a high concentration of risk in one area, as a downturn in that particular industry or company could result in significant losses for the investor. To avoid this, it's important to have a mix of different investments in your portfolio, including stocks, bonds, real estate, and alternative investments. This can be achieved through a combination of individual stocks or through the use of exchange-traded funds, ETFs, or mutual funds, which provide exposure to a diversified portfolio of investments. It's also important to consider geographical and currency diversification, investing in a mix of domestic and international assets. This helps to reduce the impact of events specific to a particular country or region. Error number 2. Timing the market. Many people try to time the market by predicting when the market will go up or down and making investment decisions accordingly. This is a common error as people often want to buy low and sell high. However, timing the market is extremely difficult and most often results in missed opportunities or poor investment decisions. To avoid this, it's important to focus on long-term investments and stick to your investment plan, regardless of short-term market fluctuations. This means investing regularly, even during down markets, and holding onto investments for the long term, rather than trying to time the market. Dollar cost averaging is a strategy that can help with this, by investing a set amount of money at regular intervals, regardless of the current market conditions. Error number 3. Chasing returns. Chasing returns is another common mistake, where people buy investments that have performed well in the past, thinking they will continue to do so in the future. However, past performance is not a guarantee of future results, and high returns often come with high risk. To avoid this, it's important to do your research and choose investments that align with your financial goals and risk tolerance, rather than just the ones with the highest returns. This means considering factors such as the company's financials, the industry it operates in, and the overall market conditions. It's also important to understand that the highest returns often come with the highest risk, and it's better to aim for steady, consistent returns that align with your investment goals, rather than trying to chase the highest returns. Error number 4. Not having a plan. Investing without a plan is a surefire way to make mistakes. Having a plan means having specific investment goals, a risk tolerance, and a strategy for achieving those goals. To avoid this, it's important to take the time to define your financial goals and risk tolerance, and then create a plan for achieving those goals through investing. This can involve working with a financial advisor, creating a budget, and regularly reviewing your portfolio to ensure it aligns with your goals and risk tolerance. Having a plan also means considering the impact of taxes on your investment returns, as well as the role of inflation and its effect on the purchasing power of your money over time. By being aware of these factors and considering them in your investment plan, you'll be well prepared to navigate the ups and downs of the market and achieve your investment goals. Error number 5. Ignoring expenses. Expenses play a critical role in the overall performance of your investments, as they can eat away at your returns over time. Many investors ignore expenses, such as mutual fund fees, brokerage fees, and advisory fees, but these costs can add up significantly over time. To avoid this, it's important to understand the total cost of your investments, including both the cost of the investment itself and any associated fees. This information is readily available and can be found on the investment's prospectus or by consulting with a financial advisor. By keeping expenses low, you'll be able to maximize your returns and achieve your investment goals. Error number 6. Not rebalancing your portfolio. Rebalancing your portfolio involves periodically adjusting your investment mix to maintain your desired asset allocation and risk level. Not rebalancing can result in a portfolio that is overly concentrated in one area or too heavily tilted towards one asset class, increasing your risk and potentially reducing your returns. To avoid this, it's important to periodically review your portfolio and rebalance as needed to ensure it aligns with your investment goals and risk tolerance. This can be done by selling investments that have become overweight and buying investments that have become underweight, or by making new investments to bring your portfolio back into balance. Error number 7. Not considering tax implications. The tax implications of your investments can have a significant impact on your overall returns, and many investors ignore this factor when building their portfolios. For example, investing in tax-inefficient investments, such as individual stocks, can result in higher taxes and lower overall returns. To avoid this, it's important to consider the tax implications of your investments and choose investments that are tax efficient, such as index funds and exchange-traded funds, ETFs. You can also consider tax loss harvesting, which involves selling investments that have lost value to offset gains and reduce your overall tax bill. In conclusion, these are some additional important factors to consider when building an investment portfolio. By avoiding these mistakes, you'll be well on your way to building a successful investment portfolio that aligns with your financial goals and risk tolerance. Remember, investing is a long-term strategy and it's important to be patient and stick to your plan, even during short-term market fluctuations. And that's it for today's video. We hope you found this information helpful and informative. If you have any questions or comments, feel free to leave them in the comments section below. And, as always, don't forget to like and subscribe for more content from the channel.